September series ended on a weak note with the Nifty falling well below the crucial psychological level of 11,000, and that was amid the uncertainty over economic recovery and the rising COVID-19 infections. Let's do a three-point analysis to find out what's the road ahead for Indian markets and what should investors do. 1. Factors behind the market crash yesterday. Well, domestic equity indices slumped 3% on Thursday following a rout in US stocks overnight after a number of Fed officials suggested that the US economy was worse than what the market was pricing in. Now, Sensex in the Indian market slipped over 1,000 points and the Nifty closed above 10,800 levels in yesterday's trade. This was the highest single-day slump since May 4, as foreign investors sold shares at a faster pace in about 3 weeks. Now, the global markets have already been facing the heat and the renewed concerns about further delay in the economic recovery as the world continues to grapple with the relentlessly spreading COVID-19 pandemic. Also, the resurgence in the new infections in Europe has led to concerns over probability of fresh lockdowns in certain geographies. Now, that's a big concern. Also, US elections are to be held in November, and usually near elections, the volatility also goes up dramatically. Now, all this together cumulatively weighed on the sentiments in the domestic markets as well. Indian stock markets saw an erosion of 11 lakh crore rupees of investors' wealth, and that is over last 6 sessions, with benchmark equity indices falling sharply. Also, foreign institutional investors have sold about 8,400 crore rupees of Indian shares so far this week, and that includes 1,885 crore rupees worth of shares in just yesterday's trading session. 2. Have markets topped out for the year then? Well, D Street analysts believe that there is more pain in the offing and investors should not expect any respite just yet. Also, market expert Sandeep Sabharwal says that we should see lower levels over the next 2 weeks at least before the market settles down. Now, so far we have already seen more of a liquidity-driven and a hope rally with benchmark indices rising 50% from March lows. But the economic pain and the reality is somewhat hitting now. Now, the huge V-shaped recovery investors were playing for might not be able to be sustainable even going forward with just monetary stimulus, as the fiscal stimulus given by many of the large economy wears off. Also, Nagaraj Shetty, the technical research analyst of HDFC Securities, believes the short-term trend of Nifty has actually turned down sharply and there is a possibility of even more weakness in the short run. Now, Vaibhav Sanghvi also spoke to the media, and he's the co-chief executive officer of Avendus Capital. He views this as a healthy correction, which was definitely bound to happen sooner or later. That's something that he believes. 3. Should investors buy this fall or wait for better visibility right now? Well, Abhinamanyu Sofat, who's the head of research at IIFL Securities, believes that 10,800 could be a decent support. Now, maybe we can see some recovery over here. However, if the market really slips further, it could definitely give jitters to small investors. Market veterans have estimated that the stock markets have actually seen 50 lakh new investors since March, and they believe that these investors have been the key reason behind the market sustainability amid the foreign outflows and also the tepid mutual fund participation so far that we have seen during the lockdown. Now, they also note that over the last decade or more, September and October months have been quite volatile for the markets. So that's something that we need to watch out for. While the long-term investors experts suggest that they should buy quality names on dips and create a long-term portfolio, but short-term traders can actually see a bearish trend continue for at least next 2 to 3 weeks, and experts suggest them to sell on rise.